Hello, everyone. Good evening. Um, so before I start anything off, I just want to say that this stream is not about anything trading related. This is just a document I was reading that was published November 1st, 2022, talking about dollar funding stresses in China. And this talks a lot about the US dollar and how China plays a big part in, it analyzes what China is doing with US dollars. So I just started reading this document. I'll be talking about the first half, and I will be doing a part two. But this is pretty scary stuff. If not scary, but it goes against a lot of the narrative that's out there that a weaker dollar is good for China. Actually, a stronger dollar is good for China, and I'll be explaining exactly sort of how I think that Chinese could be benefiting off of US dollars in order to then become the new dominant currency. But at first, we need to see the yen. Like I've always said this, if we want to go back to, let's say, a gold standard, there isn't enough gold in order to take on the deficits that the United States has with its paper dollars, right? So if you want to move from one reserve currency to another, you have to use a currency that you can print or something you can just create, because that's the only way that you're going to have a bunch of deficits that will match the current deficits we have today. Or else people need to lose homes, they need to lower their standard of living, and there's going to be a lot more poverty, and money will basically be destroyed. Right, so this is kind of like, you see what China is doing is they're in dollars. They're very much in dollars, and they benefit from the dollars. And so this document by the Federal Reserve Bank of Boston in 2022 just talks about how China is benefiting from the strengthening US dollar, which eventually then they can take their currency, the yuan, or whichever it is, and then peg it to the dollars at one point in the future. So again, not trading related, just going to be about this. I know it's Sunday, and maybe some people thought it was going to be a weekly analysis, but I'm just going to be talking about this document because I found it very interesting, and I'll be talking specifically about the first half. So I've highlighted a couple things, and I have a couple notes that I want to go through. Let me start with my notes. All right, so it's a better understanding before we actually get to the whole document. Maybe actually we should read the introduction first. So this is from October 23rd, 2022. The need for US dollar funding during the financial stresses in mid-March. Oh, hello, DSCT. Thank you for the sound check. So the need for US dollar funding during the financial stretches in mid-March 2020 as the COVID pandemic news shocked markets was evident in a number of countries. Notably, however, China's dollar liquidity needs received little attention. Given China's significant economic and financial linkage to the United States and the rest of the world, financial instability there could have implications for the global economy. Hence, it's useful to develop a deeper understanding of the dollar liquidity needs of the Chinese banks and non-financial corporations, to probe whether existing avenues of the dollar funding banks for other firms in China are sufficient in times of stress. Let me actually put some music on. I just thought of this, so the mood is set. It's not all boring. There you go. And let me know if you hear it, if you're in the chat already. You should be able to hear it. There you go. If it's too loud, let me know. It's a little too loud. I think it's better. And it's lagging. Some jazz? Oh yeah, you like the jazz. Okay, sure, I'll do that. Yeah, I love the lo-fi, but do you have a specific one? Send the link. I'll play it. But let me know if you first hear it. Yeah, it's a little loud. I'll try and put it down. Okay, that should be better. Do you hear a little better now? Let me know if it's better now. Or actually, I can listen to it too. It's still a little loud, actually. Shit. The fuck? Okay, I hear Lo-fi, but it's all loud, and put on whatever jazz you like. Well, I don't really listen to jazz listening, but I'll just type in jazz and then jazz music. We'll see what pops up. Like the one you had when you were reading, that was pretty cool. I just don't want it to be too loud. No, I don't like that one. No, the other one was better. Alright. You can't hear it. What the fuck? Alright, man. Look, I'm just gonna read the document. If it's too loud, just let me know. Alright, but I think now you should be able to hear it pretty well. Alright, so let's keep going with the thing. Dollar fund interests abroad are actually before. Let me read my notes. So my notes on this document. Dollar fund interests in China notes. So first, you need to understand the cross-currency basis breakdown. This is ChatGPT, basically, that breaks it down. So imagine a European company taking a 1-year loan from its domestic local bank to fund its U.S. operations to hedge the currency risk. The company enters into a 1-year Euro-USD currency swap with market counterparty. In theory, the company should pay back U.S. Libor as interest and receive Euribor from its counterparty. However, in practice, when there's high demand from the dollar, the counterparty lending the dollar asks for a price premium. This premium is the cross-currency basis. So the cost calculation, this is a better visual, representation. But let's say the U.S. Libor is at 1.6%, and then Euribor is negative 0.4. Then the theoretical cost of the Euro-USD currency swap to European company would be 2%, right? Because you add the two percentages, or you subtract the two percentages, because it's a negative, it's going to add up to 2%. If the counterparty quotes a basis of 50 basis points, or negative 50 basis points due to a dollar shortage, so if they don't have enough dollars and they're going to lend you dollars, they're going to want more back, so they're going to increase it to 2.5%. So they're going to add this 0.5% currency basis. Okay, so when there's dollar shortages, the currency basis reflects, the fact that it's higher, or that there is one in the first place, reflects that there's more, there's a shortage of dollars in the market. The more negative the basis, which means the more you add to this percentage, the 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 more severe the shortage. For dollar-funded investors, a negative basis can work in their favor when hedging currency exposures. A negative basis benefits dollar-funded investors who lend out dollars today and receive them back in the future. And this is what China is doing. They're lending a lot of dollars, and you'll see that how much dollars in the document. It says that the amount of dollar, if you look at their dollar liability and US dollar is what I'm talking about, but US dollar liability and US dollar assets, it's in the billions, hundreds of billions, and it represents 20% of their actual external debt, which is a lot. It's among the highest in the world. So these guys benefit very much when the dollar strengthens. So they don't want the dollar to go down. They want dollar to go up. I think they're even helping the United States in a way. But let's keep going. In 2022, several factors contributed to a shortage of US dollars. And this is going to be like, if you look at the stock market in 2022, it kind of just went down. Like, this is why. Right? The global economic uncertainty, the ongoing effects of COVID-19 pandemic led to increased demand for safe haven assets like the dollar, rising interest rates, trade imbalances. Some countries faced trade imbalances where they imported more than they exported, leading to a net outflow of dollars, and debt obligations. Many countries and companies had significant dollar-denominated debt, and geopolitical tensions such as Russia-Ukraine conflict. These factors combine to create a significant demand for US dollars, leading to a shortage in various parts of the world. And so in 2022, the markets kind of crashed because there was a shortage of US dollars. Okay? And they talk about this in this document because it was written in 2022, and this is kind of like what prompted them to write the document. Anyways, with that out of the way, let's get into the document. So, dollar funding stresses abroad are instantly observable. Let me put my volume down, it's too loud. For a given currency, this basis is the difference between the interest rate for borrowing dollars directly and the interest rate for borrowing dollars synthetically, by combining a foreign currency borrowing with the foreign exchange derivatives. And I read a definition there, and this is what I wrote in my notes. Okay, the cross-currency basis. If funding markets are efficient, arbitrage is the practice of taking advantage of a difference in two or more markets, striking a combination of matching deals to capitalize on difference. Okay, so if funding markets are efficient, that means the arbitrage between the two alternative methods for borrowing dollars keeps the basis near zero. When access to dollar funding is stressed, however, the magnitude of a cross-currency basis relative to the dollar can become significantly negative. And this is what I talked about in my notes, right, on what I showed you on Notion. The balance sheet constraints of potential arbitrage banks. For example, and then this, I didn't highlight anything here, but this just gives an example in mid-March 2020 between US and the Korean won. So you can pause and read this if you want. But I want to try and get to the parts I want to talk to. So the US dollar and CNY, which, let me make sure I am saying it properly, but it's the won. It's one of the wons. The Chinese have two different currency. Like, they have like this. Oh yeah, this is the renminbi, but they have one that's like for outside, and then one for inside. But I think the CNY is the one for outside that they lend out, and then the CNH is for the inside the country. Let me see, actually, CNY versus CNH. Just want to make sure I know which one is which. So yeah, there are two types of Chinese yuan. CNY is onshore yuan, traded in mainland China. Okay, so CNY is the one traded inside China, and CNH is the offshore yuan traded outside China. So CNH is outside China. So if you're trying to use CNY around the world, it's not going to work well. It only really works in China. Okay, so the USD to CNY and USD to CNH bases also became quite negative in March 2020, as shown in Figure 1. It's down here. A tripling in magnitude to about 110 basis points. Compared with a set of advances advanced economies and emerging market countries whose banks also had large US debt exposures, China was among the countries with the largest negative cross-currency basis in March 2020. And that means that basically they were able to charge a lot more for their lending than you normally would get if there was less shortage of US dollars. And this is because they had a lot of US dollars. So the basis for USD to CNY and USD CNH in March 2020 were more than 4 standard deviations below their 2019 means, lower than that of any other major foreign currency. This is clear evidence that the Chinese banks had significant difficulty obtaining dollar funding at interest rates prevalent in normal times. Evidently, China was not an exception with respect to the widening of cross-currency bases, as many dollar-dependent markets, most notably Japan and the euro area, experienced the same form of stress. As financial market conditions improved alongside the rapid policy responses by central banks around the world, the difficulty of obtaining dollar funding subsided, and the cross-currency bases between the US and currencies of some countries with access to the dollar swap lines not only reverted to pre-March levels, but even turned positive, suggesting that countries with adequate source of dollars became dollar providers. This could have benefited countries such as China that had no dollar swap lines. So China didn't need dollars, so they had a bunch of dollars. And they were able to lend dollars, and they became the providers of dollars. And so they grew their assets in denominated in dollars. It did eventually recover, albeit a bit more slowly in other cross-currency bases. Okay. So this is the figure 2 that they talked about up here. And then it shows you, the cross-currency basis score. So most countries in the world, like Europe, England, New Zealand, Australia, a lot of these Western countries that use a lot of dollars, but that grow their debt in dollars. Right? These countries had lots of positive deviations in cross-currency basis, which means they were needing dollars. They needed dollars, and they didn't have dollars. They were not lending dollars. They were borrowing. So China, right, both their yuan currencies, and Japan, Japan you'll see is pretty crazy too, but all of these countries down here actually were lending dollars, and they were able to have these negative. They were able to benefit off the shortage of dollars. Okay, heavy global reliance on dollar-dominated debt. At least what I just said may be wrong, but I think this is from what I read and what I asked the AI. This is sort of what I kind of understand from this. But I think, where do they mention figure 2 up here? Lower. Okay, yeah. More lower than any other foreign currency as shown in figure 2. This is clear evidence that Chinese banks had significant difficulty obtaining dollar funding, interest rates prevalent in normal times. Okay. All right. Let's keep going. So the extent of China's dollar-denominated debt. This is where it gets pretty crazy. All right, this is pretty crazy here. But heavy global reliance on dollar-denominated debt has been a phenomenon for some time. Non-US banks commonly issue short-term dollar liabilities, and did so even before the run-up to the global financial crisis. Many non-financial firms in foreign countries also finance some of their activities in dollars. The dollar liabilities of non-US banks have now surpassed their 2007 level, as shown in figure 3. Okay. To the point, what is it saying? Reproduced from Peter and the IMF. Okay. Let me keep reading. Have now surpassed their 2007 level, point to the increased extent of dollar borrowing by foreign entities, including non-US banks, non-bank financial institutions, and operating companies. The outstanding quantity of dollar-denominated international debt securities and cross-border loans is 26% of global GDP and 50% of outstanding debt securities in all currencies. Okay, so this is pretty huge. Let me read one more time just so I understand really what it was just saying. Point to the increased extent of dollar borrowing by foreign entities, including non-U.S. banks, non-bank financial institutions, and operating companies. So the outstanding quality of dollar-denominated international debt securities and cross-border loans is 20%. But whose GDP are they talking about? They're talking about China. Oh no, they're talking about non-U.S. banks. This must be about United States GDP though. So the dollar-denominated international debt securities and cross-border loans is 26% of global GDP. Probably they're talking about the federal. This is a document by the Federal Reserve. So probably they're talking about United States GDP. And 50% of outstanding debt in all securities. Factors support this is pretty big numbers, but factors support global reliance on dollar funding include complementary between dollar trade invoicing and the dollar as a safe haven. This is pretty big. I mean, 50% of the outstanding debt securities in all currencies are dollars, right? So that's pretty big, and thus seen as a safe haven. So this sort of shows you the foreign position in the black line, I suppose, is the highest. But let's keep going. Wait, foreign position, that must be just adding all these three, the red, green, and blue. Maybe, I don't know. Okay, so China's dollar-denominated debt is primarily issued by its bank, corporation, and local government financing vehicles. The latter two categories are often lumped together. All right, so before providing a rough sense of magnitudes of dollar borrowing by Chinese entities, we emphasize the incompleteness of the available data. All right, so for example, the currency denomination of debt issued by Chinese entities is often not reported or is reported inconsistently. Maturity information is typically difficult to find. So this is basically because the Chinese are very private people. They don't share all their economic news like the United States does, and that's because it's China. They have their own reasons, like national security, whatever. Document that says that let me just listen to my stream. I want to. If you look at their dollar liability, hear the music. U.S. dollar is what I'm talking about. The U.S. dollar liability. I can't even hear the music. Whatever. All right, so. Yeah, it's just the United States wasn't always sharing all their news. Even actually, if you search up FastSab, I think 62. FastSab 62. I'll find the video or a link to a page for the next part, but not the United States says that the numbers which it reports don't represent the real numbers, right, for national security reasons, but that investors can use these numbers to make business decisions, that they're not like completely wrong. And so like not even the United States actually reports the real numbers, but China doesn't report any numbers at all, and this is because they're very private. And so the data that they're going to talk about here, it's not fully complete. They're missing a lot of things, and it's giving you a rough idea of the position China's in, but it's not the whole picture. So the dollar exposures of China's banks. The Chinese bank system is the largest in the world, with total assets in Q1 of 2021 about 330 trillion renminbi, which is the Chinese currency, or about 325% of GDP, which is also high by global standards. Although much of the domestic activities of Chinese banks are denominated in renminbi, the largest banks are highly active abroad and rely most heavily on the US dollar and lending. Banks dominate the Chinese financial system, holding over 2/3 of its assets. They are highly interconnected with other parts of China's financial system and real economy. According to the publicly available BIS banking data, as of Q3 2021, internationally active reporting banks in China have cross-border liabilities accounting to 1,563 billion, of which 586 billion, or 37%, is dollar denominated. So the liabilities between other countries was, which is the amount of money that they've borrowed, was 1,563 billion, but 586 billion of that was in U.S. dollars. Okay. However, these same banks, and this is just this is not all the banks in China. This is just the four biggest one. Okay. Have, because they don't have all the data, have 1,057 billion in cross-border dollar-denominated assets. Right. So they have a lot more, almost twice the assets in U.S. dollars that they have in liabilities of U.S. dollars, which is putting them in a very strong position for U.S. dollars. And this implies a large dollar funding gap. Most countries have a negative dollar funding gap. It means that they have more dollar debt than dollar assets. But China is not like that. China has a lot more dollar assets than dollar debt, which means that they're at less risk if there's economic stress. And they have more of that safe haven that everybody wants during economic stresses. And so they're in a much better position. So the BIS data cover total cross-border assets and liabilities in a given currency without a sub-breakdown for maturity. And this is a crazy statement here, but according to public BIS data, the on-balance sheet for dollar funding gap of 471 billion, this is if you take the 1,057 billion in assets and you subtract the 586 billion in liabilities of US dollars, you get this number, 471 billion. So this is a surplus, a positive dollar funding gap, and it represents, or it's equal to 20% of their external debt, which is the amount of debt they have externally with other countries. That is huge. It's very significant. It's putting them in a very strong, like a fifth of their total debt can be paid off, which is insanely huge. Right? So putting them in a very strong position. And what happens when the United States interest rates stay up? Well, this debt that they have, sorry, not the debt, the assets that they have, now they're getting more interest on that. It's dollar strengthening, and they're benefiting from it. So if anything, China would want the United States to keep growing stronger, and the China will keep lending to other countries. So typically, a dollar funding gap is associated with a reliance on short-term dollar liabilities to fund long-term dollar assets, representing a potential source of financial instability. China's bank supervisors monitor mismatches between assets and liabilities in major foreign currencies. Chinese banks likely cover some of their large dollar funding gap with derivatives such as currency. And this is not really important stuff. Comparing with funding gaps in other countries, publicly available BIS data suggests that the dollar funding gap for China's banks is relatively large, in line with those of Japanese and Canadian BIS reporting banks. And the BIS is basically, I don't know what it stands for, but it's basically like a international central bank. Let me actually search up what it stands for instead of saying the description. Bank for International Settlements. So BIS is like, they basically represent all the central banks in the world. The Bank for International Settlements is an international financial institution which is owned by member central banks. So it's just owned by central banks. Its primary goal is to foster international monetary financial cooperation. So it reports, I believe every quarter or something, how all these central banks and countries are doing with their, monetary policy and all that stuff. All right, so, where was I? Okay. Banks in countries with negative gaps, such as those of Australia, France, and the United Kingdom, as well as U.S. banks themselves, would in principle be to China's banks. Yeah. Borrowing short-term, lending long-term. Did I say? I don't know if that's okay, but it's borrowing short-term and lending long-term. So this means that they're a little risky. It means that they're borrowing long-term, and it was 93%. So without more maturity information, we're unable to deduce the exact extent of the liquidity rollover risk. What a rollover risk is, this might be wrong, but if I'm getting it correctly, or let me actually just search it. But rollover risk refers to the chance that a borrower may be unable to refinance or renew the existing debt obligations at favorable terms, or in some cases may not be able to refinance at all. And so basically that is if you have balance sheet issues, right, where you need to come up with the money, and you need to like pull out equity or sell bonds. You may not be able to because there's no liquidity, or because for whatever reason you just can't refinance, or you can't roll over that debt and liquidate your position. So in bonds sense, I think that would be like if a bond was, if the rates went up and the price of the bond went down and you wanted to sell at market because you needed to, you might take a loss, and that loss might be substantial enough where it could hurt you. I'm pretty sure this is a good context to talk about that rollover risk, but the dollar proportions indicate that these risks could be large. All right, so they're at high risk, which means that if this would be bad for them if I'm not actually sure how this could be bad for them. But the average maturity of bank debt tends to be relatively short in comparison with other non-bank corporate. But I highlighted this because it kind of shows you that the debt that they've issued in dollars are for long term. So that could put them in a tough situation if the United States keeps raising the rates, because if they become more at risk of rolling over their, if they need to roll over their debt, and the bonds that they've issued, people want to sell them, and hold on, how would that? No, I said that right. I'm trying to. Let me keep reading and I'll come back to that idea. But Chinese banks also have dollar liquidity credit exposures through their lending to borrowers in countries involved with the Belt and Road Initiative. No, this is going to go on to a different idea. Let me finish this one. Okay, so let me read of the international debt outstanding, 63.5 billion, 79% is dollar denominated. Of the total bank debt, the original maturity is over 1 year, is 93%, which means that they're exposed long term. So if the United States keeps raising the rates, they might need to roll over their debt. The thing is, the reason why China would actually be safe, even though the risks are large, is that they have a lot of dollar denominated assets. So because this is not really important. Okay, so maybe this is, unfortunately, neither the maturity nor creditor composition of the liabilities is evidence in the reports. On the other hand, the balance sheet of one of the largest foreign currency lenders, the China Development Bank, a government-owned entity, does appear to have significant dollar exposures amounting to 100 billion in 2020, according to its annual report. The takeaway from all that is that the liquidity risk may be somewhat less for the four commercial BRI reporting banks, though it is impossible to predict the gauge liquidity risk from the public data. So if there's a dollar shortage in the world, China's safe, basically, is what you need to know. And if the dollar strengthens and there's more dollars in the world, China benefits from that. Even in because they have so many loans, the more the dollar strengthens, the more actual wealth they accumulate. And then this is where I stopped, and I need to keep reading. There's a lot more numbers here, right? But they're going to talk about the dollar exposure of China's non-financial firms, and then they're going to talk about China's US dollar exposures are growing, and this is a big important part, how they're growing, and I wonder where it is at today. But spillovers from China, and I think that's it. Oh yeah, potential solutions to a lack of US dollar funding for China, and that's a whole lot of stuff. But just the main idea that I wanted to get out from just reading this for part one is, there's a lot of things, I'll be honest, in this document that I have trouble understanding, but I understand the important things, which is that China is obviously in a very strong US dollar position, and that they don't want the dollar to weaken. They absolutely don't. But that if they wanted to become the next powerhouse in the world, right, whatever currency they, if this is BRICS currency or whatever, they need to be able to peg it against the US dollar. And so if they own a lot of these loans, if they own a lot of the debt that's denominated in dollars, right, through assets, more assets and liabilities, and they have a positive dollar funding gap, well, that would be very good for them. And eventually, as it grows, as that, as it's going to suggest in part 2, that the dollar exposures are growing, as that grows, China is going to become much more powerful globally and in a better position with the dollar. Eventually, maybe they're able to start to lend out, or not lend out, but the yuan becomes more attractive. The Chinese yuan becomes more attractive, or the renminbi, whatever, it becomes more attractive because China has so many dollar assets. And if the United States is on an unsustainable debt path, this could help a lot of that debt go from the United States to China, which could benefit the United States. And eventually, China may be able to take over. But there's nothing in here that suggests that China is looking for a war. And so I hear a lot of people saying that, China and the United States are going to get into a war. Well, that wouldn't really benefit the dollar. Actually, I don't know. Do wars benefit currencies? Let me search that up. I wouldn't think so. No, they don't. They definitely don't. What am I saying? In a currency war, no, they don't. I know they don't. All countries benefit negatively from wars. It's just about who benefits negatively the least, and who benefits negatively the most. So, I don't think China would be looking for a war with the United States. Just off reading this document, I think that that's an idea propagated by the media to create fear and bad investment decisions. But I'm not a financial advisor, so I'm just reading this document and I'm understanding the real world and how things are moving, in that global monetary system, and using that to understand that, this war that everyone's talking about, it's still quite a ways away. We're not going to see that we're not seeing that develop anytime soon. At least not. It's not starting to. I don't see it developing, so it's not going to happen anytime soon.